You've probably heard of the dividend snowball effect before. It's an incredibly powerful way to build wealth and to allow your dividend payments to grow larger every single year. For example, if you invested $1,000 a month in dividend growth stocks for around 30 years, you would easily have a portfolio of over $3.3 million paying you over $150,000 a year in dividend income. This dividend growth approach is the exact same method Warren Buffett used to achieve a yield on cost of over 60% on his Coca-Cola position. This is a surefire way to building wealth and living off dividends for those with a long time horizon. But what if you don't have 20 or 30 years to let the snowball effect take place? Well, let me introduce you to the Dividend Avalanche. The Dividend Avalanche is simple in theory. You utilize high-yielding investments to live off dividends at a much faster rate. But I don't think most people understand just how powerful this method could actually be. For example, we often see the finance community tout the 4% rule, which is basically the idea that you can safely withdraw 4% of your investment portfolio annually in retirement. So this means if you needed to generate $40,000 a year in dividends in retirement, your portfolio size would need to be about $1 million. But what if you could achieve a sustainable 8% dividend yield without seeing your capital erode? All of a sudden, the amount of capital you would need to retire is cut in half. You could achieve that same $40,000 a year from $500,000 instead of $1 million. That is a radical difference. But unfortunately, most retail investors trying to achieve this goal make some major mistakes. In fact, high-yield investing is quite similar to the old game Minesweeper. The premise of the game is some squares are safe to click on, but some squares are hidden mines. If you go around randomly clicking on squares, you are basically guaranteed to hit a mine, ending your game. But if you know what to look for, you can strategically avoid the mines. In this video, we're going to be discussing some of the key concepts you have to understand if you're going to invest in high-yield assets, look into how to analyze the dividend safety, and ultimately discuss how to avoid the hidden mines, all of which will help you build your dividend avalanche. I also put out in-depth research and reports on high-yield opportunities over on dividendavalanche.com, which you can find at the link in the description. Or you can simply scan the QR code that's on the screen right now. Now let's dive in. I did a fun experiment around 11 months ago. I made a video titled How to Build a Safe High-Yield Dividend Portfolio, and the video is obviously still live if you want to go check it out. Now, the goal for the hypothetical portfolio we were creating was relatively simple. We wanted to build a portfolio with a starting yield of close to around 7.5% that paid out sustainable and predictable dividends that would grow dividends in line with inflation and would not have continual share price decline. So basically, we wanted all the qualities that would allow someone to sustainably live off a high-yield portfolio. And to save you from having to go back and look at that video, here's what that portfolio actually looked like. And this was at the time of the video release. The portfolio was yielding around 7.4% with dividend growth of around 3.5 to 4%. The payout ratio on average was showing about 82%, but that's technically not completely accurate because the way we judge dividend safety for asset classes like REITs, BDCs, and MLPs is quite a bit different than traditional dividend stocks. Now, why am I showing you this portfolio? Well, since the inception of this portfolio, the average return is about 22.6%, way outperforming the S&P 500, and the compounded annual growth rate was close to 27%. We saw 6 different of these positions actually outperform the S&P 500 over the last 11 months. And this was during a time when tech stocks were exploding. But that outperformance doesn't tell the whole story, so I ran a backtest on this portfolio for deeper insights. And what we found is this portfolio had lower volatility, a lower maximum drawdown, and a stronger Sharpe ratio. And remember, the Sharpe ratio is essentially telling us how much return we're getting for each unit of risk that we're taking on. So essentially, we saw better returns while taking on less risk. So the point I'm trying to make is simple. Building a high-yield portfolio that performs well and pays out sustainable dividends is absolutely possible, but it's certainly not an easy task. And in fact, over on dividendavalanche.com, I'm actually building out a real money high-yield portfolio and putting out in-depth research and reports along with a real money dividend growth portfolio. These are portfolios built from scratch. So yes, it's absolutely possible to build out a high-yield portfolio. and to turn your portfolio into a dividend avalanche. But most retail investors don't realize they're at a major disadvantage when trying to do this. Part of the reason is absolutely due to a knowledge gap. The way we analyze each of these high-yield asset classes is a little bit different. Covered call ETFs, MLPs, REITs, BDCs, preferred shares, each one is unique and is structured differently. And some of these asset classes are somewhat more complex than a lot of traditional dividend stocks. But this isn't the only reason that retail investors are at a major disadvantage. The real problem for these high-yield asset classes boils down to one thing: lack of data. It sounds crazy to be saying this in 2025. Whether you're looking at stocks on Yahoo Finance or another platform that I think is better, which is Seeking Alpha, which I do absolutely love, the reality is these softwares don't give you the information you need to look closely at these high-yield investments. Just as a simple example, if I'm analyzing a covered call ETF, some of the key items I immediately want to know is what's been going on with the net asset value, what's the portfolio options coverage, what's the option moneyness. And unfortunately, I don't know of any softwares that cover this information. And this exact same problem is true whether you're looking at MLPs or REITs, BDCs, or preferred shares. And this is exactly the reason over on Dividendology.com I'm building out the Dividendology database. This will provide the key information and data that you'll need to know about each of these high-yield opportunities. But it isn't all bad news when it comes to investing in high-yield stocks. In fact, there's actually two major advantages. Because there's such a lack of data and so few people actually interested in high-yield investing, it creates market inefficiencies. Basically, there's a massive lack of coverage when it comes to these high-yielding assets. And the end result is pricing inefficiencies and misvaluations on the upside and the downside. And so this creates a much greater opportunity for diligent investors. If you're willing to actually dive deep into these different opportunities, and you actually know what to look for, there's undoubtedly chances to capture both yield and capital appreciation where the broader market is overlooking it. And that's exactly what we were able to do with our example portfolio. Now, there's plenty we need to touch on to actually build our Dividend Avalanche portfolio, so let's make sure we have a general understanding of each of these asset classes. And we'll start by talking about covered call ETFs. Now, if you've been paying attention to what's been going on Wall Street, you'll know that covered call ETFs have just exploded in popularity in the last 5 years. Look at the total net flows in the first half of each year since 2015 for these covered call ETFs. Since 2021, interest in these funds has grown at an exceptional rate, and 2025 is currently a record-breaking year. I'm someone who pays very close attention to this, and every single week, I have fund managers emailing me to let me know that they're releasing a new covered call ETF into the market. And I'll let you in on a little secret that's actually a quote from Warren Buffett that basically goes like this: if Wall Street thinks they can get you to buy it, then they'll sell it. What I'm trying to say is there is a plethora of really bad covered call ETFs out there. Or in other words, there's very few good covered call ETFs out there. Now, how can we tell the difference? What makes a covered call ETF good versus a covered call ETF bad? Well, we have to remember, investing at its core is about the risk versus the reward. What's the risk we're taking on to get a certain potential reward? So let's take a moment to talk about the qualities of what could potentially be a good covered call ETF. This is something I was writing about not too long ago. To start, you absolutely have to understand, covered call ETFs cap your upside. And in reality, they aren't even created with the intention of outperforming the underlying index over the long term. And so that alone makes it a suboptimal option for investors that have higher risk tolerance and long-term time horizon. Another way of saying that is dividend growth will definitely outperform covered call ETFs over the long term. However, for the investor looking to maximize immediate dividend income, covered call ETFs can have appeal, but selecting the wrong one could be detrimental. So how do we define what's actually good? Well, the ground rules come out to 3 different things in my opinion. Number 1, we want them to generate sustainable high monthly income. That one's pretty obvious. Everyone knows that. Number 2, we want no net asset value decay over time. A lot of people will make this mistake, and we'll touch on it in just a moment. And then number 3, we want it to be able to capture some of the upside of the underlying holding. All 3 of these are relatively straightforward, but they're actually all interlinked together. Let me show you some examples of what I mean. What we're looking at here is the stock Tesla, stock ticker TSLA, and in the last year, it's actually done really well. It's now up nearly 86%. If we look at them year to date, they're only up about 4.4%, but they saw a massive recovery from the March lows. They were at about $235 per share and have jumped up to $421 per share. So this is a stock that has a lot of volatility, meaning it's easier to generate options income, and in the last year, it's up about 85.92%. Now, let's take a look at a covered call ETF that has Tesla as the underlying index. Now, what we can see from TSLY is, yes, Tesla is their underlying index, and Tesla's up almost 86% in the last year, but TSLY is down 32.1%. Now, I know you might be thinking, yes, it's down 32%, but how much did it pay out in dividends? Because it could still have a positive total return. And you are absolutely right. But here's what you have to know. These dividends that are paid out from covered call ETFs, or to be more technical, these distributions are paid out of the net asset value. And ironically enough, the net asset value will actually determine how much can be paid out in dividends. Now, the net asset value is simply the value of all the fund's assets minus its liabilities divided by the number of shares outstanding. And typically we'll see funds trade very close to their net asset value. We have to remember, covered call ETFs generate income by selling call options on the assets that they hold. So what this means is that if the net asset value shrinks over time, the ETF has fewer assets to write calls on. So to put it really simply, fewer assets equals lower premiums equals smaller dividend payments. And this has been the exact case for TSLY. If we jump over to a Google spreadsheet using ticker data, let's pull in the dividend history for TSLY. Again, ticker data allows you to import stock financials into your spreadsheet. There's a link to it in the description. But here's what we can see. Since inception, these dividend payments are becoming smaller and smaller, essentially every single month. And this is despite Tesla being up almost 86% in the last year, almost 187% in the last 5 years. So the amount you're being paid grows smaller every single month. This is a major problem for someone who's hoping to sustainably live off dividends. Fortunately, this is not the case for every single covered call ETF. If we look at a different covered call ETF, GPIQ, the Goldman Sachs NASDAQ 100 Premium Income ETF, we can actually see in the last year it's up by about 11.14%, combined with the fact that its trailing 12-month yield is about 9.76%. That'd give it a total return of close to 20%, which is actually outperforming the market. But what about the dividend? Well, if we jump back over to the ticker data sheet and plug in GPIQ, we can see these dividend payments have been much more stable. And in fact, the most recent dividend payment is even a little bit larger than the original dividend payments they were making a couple of years ago. Now remember, on a month-to-month basis, you'll always see a little bit of differentiation between the dividend payments simply due to the volatility of the market. How much volatility is there? More volatility typically means more option premiums, meaning larger distributions, larger dividends. Volatility impacts the dividend size a lot in the short term, but even more importantly in the long term is what's actually going on with the net asset value. So you might be thinking, okay, this does make sense, but how can I actually know whether or not a fund is going to grow its net asset value? How can I know whether it's going to be able to take part in the upside? That is the key question. And that's my problem with a lot of softwares. They don't have this information. And again, that's why I've actually built the Dividendology database. And one of the things that I've been sharing with you guys for free lately is the covered call ETF database that I put together. It took about 9 months to make, and I'm constantly adding new funds to this sheet. There's plenty of information on here. I link to the fund's homepage, have things like the yield, assets under management, what it's tracking, the ETF name, as well as some other information. But really, the most important information we want to look at is the options moneyness, portfolio options coverage, and again, whether or not net asset value has been growing since inception. I've been harping on these three metrics for a while now, but they're so important. Let's look at a fund like GPIQ again and see what it looks like and why it's been able to grow its net asset value and maintain that high dividend yield. Here we can see GPIQ, again, a fund from Goldman Sachs. If we scroll all the way over, let's start with options moneyness. We can see they use out of the money calls. Now, typically there's three different strategies that we'll see: at the money calls, in the money calls, and out of the money calls. If a fund is using at the money calls, this will typically generate high premiums, but it caps basically all of the upside. So it can be good in sideways or potentially slightly bearish markets. Then we have in the money calls. This is typically going to be the highest premiums, but it completely sacrifices all the upside. So it's very defensive, better in bear markets. But then we have out of the money calls, and this will generate lower premium, but it allows them to be able to take part in some of the upside. And so it's better in bullish markets. Now, here's the thing. Historically speaking, the market continues to climb higher. Yes, we'll occasionally have a year where we have a pullback like 2022. But what do we know about the market? over time it continues to climb higher. Therefore, out-of-the-money calls are going to be optimal for covered call ETFs. This is what GPIQ uses, and it helps them take part in the upside. But here's what's perhaps even more important specifically for GPIQ. We can see their portfolio options coverage can range between 25% to 75%. This is essentially telling us how much of a covered call ETF's underlying stock portfolio is covered by call options sold to generate income. So if a fund has 100% options coverage, it means nearly all of the holdings have calls written against them, which is going to maximize income, yes, but it's going to cap the upside substantially. If the coverage is only 50%, only half the portfolio is covered, meaning they're generating income from about 50% with options, but it allows way more room for the fund to actually take part in the upside. And so because GPIQ is actively managed, the fund managers will actively change how much of the portfolio is covered with options. And so far, this seems to be working out really well for the fund because, again, the upside has been pretty solid. In the last year, they're up about 11%, and they've still been able to generate a yield of close to 10%. So these two factors here, the options moneyness, the portfolio options coverage, is the exact reason they've been able to grow net asset value since inception, which is the exact reason that the distributions have continued to remain stable and even slightly increase. Everything we see here is tied together. These distributions are absolutely impacted by what's going on with the net asset value, and the net asset value is completely determined by what type of strategy the fund is using. If you want to get access to this covered call ETF sheet for free, I'll put a link to it in the description. Now again, I do want to give you one more final warning. At the time I made this post on dividendology.com, there were 65 covered call ETFs in the Dividendology database, but only 26 had grown net asset value since inception. That's only 40%. So please heed my warning. There's a lot of bad covered call ETFs out there. They can absolutely be used to build a high yield portfolio, but you have to know what to look for. And you have to know whether or not those distributions, those dividends have the ability to be sustainable. Now, while we're on the subject of the fact that there are a lot of bad covered call ETFs, let's go ahead and talk about business development companies for a moment, because there's a lot of bad business development companies as well. In fact, as I was putting together the Dividendology database, I added 42 different BDCs, and what's interesting is only 13 had positive tangible book value per share growth over the last 5 years. That's only 31%. Now, don't worry if you don't know what tangible book value per share growth is. It's an important metric, and we'll get to that in just a moment. So yes, lots of bad BDCs out there, but they can definitely play a role in a high yield portfolio and really boost your gains and highly boost your income. And the most popular BDC out there is going to be Main Street Capital, stock ticker MAIN. It's very likely that you've heard of this BDC before. It's a very popular monthly dividend payer, and the returns over different time periods have been very, very good, really outperforming the market. We can see in the last year, it's up about 32%, while having a yield of about 6.5% in the last 5 years, over 117%, and in the last 10 years, up 138%, but even that doesn't paint the full picture because most of the returns you're going to get from this BDC is going to be in the form of a dividend. Now, what even is a BDC in the first place? Well, BDCs are basically an investment vehicle that was created by Congress in 1980, and essentially the goal was to help provide funding to small and mid-sized businesses in the United States. Now, BDCs are like REITs in a few different ways. For example, BDCs are regulated investment companies just like REITs. BDCs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends, again, just like REITs. So there are some similarities in the way these two asset classes are structured, but at their core, they're still very different. And unfortunately, like covered call ETFs, the way we analyze BDCs is just radically different from other asset classes. And again, while I do love Seeking Alpha, pretty much no software out there provides the data you need to analyze BDCs. Now, the actual business model is relatively simple. They essentially provide loans to smaller businesses that might struggle to get traditional bank financing. Now, the businesses they provide loans for have to pay the BDC interest, and it's typically at a pretty high rate. Think around 8 or even sometimes double-digit percentiles. And so if BDCs are wise with the loans that they make and they collect large interest payments, then this gives them the ability to make really large dividend payments. For example, if we look at another popular BDC, we have Blue Owl Capital Corporation. It has a starting yield of close to around 12%, or at least that's what softwares tell us. And here's the first mistake most investors make when trying to analyze BDCs. They look at the starting yield sitting here at 11.75% and just assume that that's the dividend yield for the company, but that's not actually the case. In fact, let's just look at the Dividendology database for BDCs over on dividendology.com. We have it right here. There's data and information that I personally have to manually update every single month on these BDCs. But if we zoom in and take a closer look, you can see one of the metrics that I've been tracking is the base dividend yield versus the total dividend yield. Now, what's the difference? Well, one of the problems with a lot of softwares is they only list the total dividend yield. That's what we were seeing over on Seeking Alpha. But we have to remember, this total dividend yield includes special dividends. Now, that's really important to make note of because when we're operating in the right economic environment for BDCs where interest rates are high or climbing, they're able to generate extra interest income, and as a result, they're paying out a lot of special dividends. What we can see here is the dividend history for Main Street Capital. In the gray, we have the base dividend payments, but in the green, we have the special dividend payments. So historically speaking, they've been making a lot of special dividend payments, which is going to boost the total dividend yield you see on these softwares. But in reality, as interest rates fall, which is happening right now, those special dividend payments are going to decline even if the base dividend payments are increasing. So you might buy this BDC thinking you're getting a specific dividend yield, but in reality, that dividend yield is going to be even lower. And this is why we have to differentiate between the base yield and the total dividend yield. The base yield is the yield you should feel more confident about getting as long as the company is generating sufficient net interest income. And so for some of these companies, there's a really big difference. For example, look at Goldman Sachs BDC. Their base dividend yield is 11.1%, but the total dividend yield is 16.7%. That's a radical difference. Now, just as important as analyzing the base dividend yield versus the total dividend yield is analyzing base dividend coverage. When we talk about these BDCs, we don't look at the payout ratio. Instead, we look at a metric called the base dividend coverage. This is basically telling us how well a BDC's earnings can support its dividend payments. And for BDCs, the metric we look at is net investment income. That's the key metric. Now, net investment income is basically going to be the cash profit from the interest, the fees, and other recurring investment income, minus any expenses for borrowing cost. So net investment income is actually going to be the income that's available to pay out dividends. So this base dividend coverage is simply going to be net investment income divided by dividends paid. Now, make note, for base dividend coverage, we're only talking about the base dividends being paid out, not the total dividends, including special dividends. So when we look at a company like Ares Capital Corporation, we can see their base dividend coverage is sitting right at 102.1%. So what are some things that we should think about? Well, the company is barely generating enough net investment income right now to cover that base dividend yield, and we also have to keep in mind that if interest rates are dropping, it's very possible net investment income is going to be declining a little bit in the coming months, which would put that base dividend coverage at risk. Now, compare that right now to Hercules Capital. They have about 125% base dividend coverage, which is quite a bit healthier. But one of the things we also have to make note of is not just base dividend coverage, we have to talk about the spillover. What does spillover mean? Well, like we mentioned earlier, BDCs are required by law to pay out 90% of their taxable income in the form of dividends. So that means they don't always pay out exactly 100%. They don't necessarily pay out all of their net investment income. And so any extra income that they earn but don't distribute is called spillover. Now, to summarize spillover, that's essentially going to be like a savings account of earnings that can be used to support or increase dividends later on. So technically, even if Ares Capital had a base dividend coverage that dipped below 100%, if they wanted to maintain that base dividend, they could dip into that spillover account just a little bit. But keep in mind, it's up to management. It's not guaranteed that they would do that. And ideally, we don't want the BDCs that we own in our portfolio to have to dip into their spillover. For example, that's like if we, as just humans in general, were having to dig into our emergency fund to fund things like our electric bill or our mortgage. It wouldn't be good. So yes, we need to know the difference in base and total dividend yield. We need to know what base dividend coverage looks like, and we need to know whether or not net investment income is going to be growing or shrinking, because that really determines how sustainable those dividends will be. Now, we have to remember the business model for these BDCs. And so the question you should be asking yourself is, how sensitive are they to interest rates with the loans they're giving out? Well, it depends. Are they giving out fixed rate loans or variable rate loans? This is something else that I have listed out right here, the amount of variable rate debt. And for the vast majority of BDCs, variable rate debt is very high. So again, as we see interest rates decline, a lot of the times the net investment income that these BDCs are going to bring in is going to decline as well. That's why it's scary when I see a base dividend coverage at 102%. But keep in mind, there's a few BDCs where it's relatively low, at least compared to other BDCs. For example, Main Street Capital, a very strong base dividend coverage ratio, and their variable rate debt is just 53.8%. That's the lowest among most of BDCs, meaning they're going to be less impacted by declining interest rates. So this variable rate debt, very important to make note of. So those are some interesting concepts to touch on with BDCs as it relates to their dividend, and ultimately that's why you would invest in these types of assets, for that dividend and hopefully for the growing dividend if possible. But how do we actually know whether or not they're growing their intrinsic value as a business? I mean, for most stocks, we can look at whether or not they're growing earnings per share, free cash flow per share. For a REIT, which we'll talk about later, we want to know whether or not they're growing adjusted funds from operation per share. Well, like I mentioned earlier, when it comes to BDCs, we want to look and see whether or not they're growing tangible book value per share. And again, this is something I've been tracking closely. So again, if we just use Ares Capital Corporation, we can see over the last 3, 5, and 9 years on a compounded annual growth rate basis, they have indeed been growing their tangible book value per share. Unfortunately, like I mentioned earlier, this is actually rare. Only 31% of the BDCs in this database over a 5-year time period had positive tangible book value per share growth. Now, what even is TBVPS? Well, it's relatively simple. It's going to be the total assets minus total liabilities divided by shares outstanding. What that means is it does not include intangibles like goodwill, for example, so it's a true measure of the net worth of the BDC. And again, just like how we touched on when it comes to covered call ETFs, we have to see growing net asset value for the dividends to be sustainable over the long term. When it comes to BDCs, we need to see growing tangible book value per share over the long term for those dividends to be sustainable. So yes, this is a measure as to whether or not they're actually growing intrinsic value, but just as importantly, it's actually also a sign of dividend safety. And one of the things we notice when it comes to the valuation of BDCs, which basically the most common way to value it is looking at the price to net asset value, BDCs that grow their tangible book value per share over time, they're going to trade at a premium to their net asset value. So for example, Ares Capital Corporation trades at a price to net asset value of about 1.12. This means that this BDC is basically trading at a 12% premium to its underlying net asset value. Investors are willing to pay more than the BDC's assets are worth on paper. And you can see why they've done a great job of growing tangible book value per share. They expect that intrinsic value to continue growing. They see the nice dividend yield, and at the moment, that dividend is covered. Compare that to the next BDC on our list, Barings BDC, we can see they trade at a price to net asset value of below 1. So this BDC is trading at a discount to its net asset value. Now, what would be the reasons for this? Maybe there's a credit rating agency that gave a poor outlook. Maybe there's poor management. Maybe they're not growing their tangible book value per share, which has been the case in this instance. Or maybe simply their base dividend coverage doesn't look attractive. So again, if we go back to our example with Main Street Capital, we can see this is actually the most expensive BDC on the market with a price to net asset value of over 2. But the reason is clear. They have phenomenal dividend coverage. Their variable rate debt is very low. They're internally managed, which actually aligns shareholders with management. And on top of this, they've grown tangible book value per share at a faster rate than any other BDC. And then, of course, as you may or may not already know, we can also just look at the credit ratings, which is something that I track for these BDCs all the way over here to the right. We can see which credit rating agency gave them what type of credit rating, and then we can normalize it as well, giving it the equivalent S&P Global rating, so we can actually compare these different BDCs. Along with this database, we have charts to look at things, tangible book value per share metrics over time, we have guides. So I'm really happy with how that database is coming together. There's a lot of great information. So if you know what to look for these BDCs, it becomes a lot easier to make wise decisions. And again, in that example portfolio that I showed at the beginning of this video, there was some BDCs in there and they actually performed quite well over the last year. So it's completely possible to utilize BDCs and for them to really boost your income and even perform well. Now, let's take a moment to talk about some asset classes that, at least in my opinion, are not nearly as destructive as covered call ETFs and business development companies. And let's start with MLPs. This stands for Master Limited Partnerships. And the example we're going to look at is going to be MPLX. Now, that's actually a stock that I own in my personal dividend portfolio, and it's a pretty big dividend payer. If we take a closer look at my dividend yield on cost for this position, Even though I just recently added it, the yield on cost is sitting at about 7.77%, and if we look at Seeking Alpha right now, that forward-looking yield currently sitting at about 7.5%. Now, if we look at the last year, it's up about 16.5%, and in the last 5 years, up almost 190%, and keep in mind that's not including those large dividend payments that it makes. So that's really impressive market outperformance for a stock, for a company that's yielding above 7%. And what's so impressive is it doesn't just stop there. Look at the way they've been growing their dividends over the last few years. 3-year dividend CAGR of above 10%, the 5-year 7%, the 10-year above 9%. It's really rare to see a stock that's yielding above 7% that also has that type of history of growing its dividend along with rapid share price appreciation. Now, with all that being said, the past performance isn't indicative of the future performance. So how can we better know whether or not they're going to be able to grow that dividend in the future, whether they can sustain its current dividend, or whether or not the dividend is safe at all? Those are the types of things we have to know to invest in this asset class. So let's just continue to use MPLX as an example. And the very first thing we'll do is jump over to the company's Form 10K. Now, just like Warren Buffett has stated in the past, 10Ks are long documents, but if you actually take the time to go through and read these documents, you will literally know more about each of these companies than the analysts on Wall Street do. Now, what's interesting about MPLX is on the very first page, you can actually learn a lot about what the key metrics we need to be looking for MLPs are. Now, before we actually start reading some of this, let's just take a step back and get a very basic understanding of MLPs. MLPs are publicly traded partnerships. They're not corporations, and the vast majority of MLPs operate in energy infrastructure. So we're talking about things like pipelines or storage or transportation of oil and gas. Now, before I go any further on MLPs, I do want to let you know if you buy an MLP, you receive a Schedule K1 each year instead of a 1099. So it will impact your taxes in that way. Now, let's start looking at this very first paragraph because there's a lot we can learn about MLPs in general simply by reading this. Through our strong operational performance and the realization of our disciplined capital investments supported by strong market and producer demand, we achieved 8% adjusted EBITDA growth to $6.8 billion. The translation of this is they think they ran the business efficiently. They think they made wise investments, and the demand from a macro perspective stayed strong. And so as a result, the profits, which they're using the metric adjusted EBITDA, and as you might know, investors like Charlie Munger have often complained about this metric. But the reason they're saying adjusted EBITDA is they likely stripped out a one-time cost or an unusual item to show what the actual recurring earnings looked like. But they're basically saying they achieved 8% earnings before interest, taxes, depreciation, and amortization growth to $6.8 billion. So 8% growth, that's solid. And they stated this is the fourth consecutive year that MPLX has generated mid-single digit adjusted EBITDA growth. So we're seeing a consistent level of solid growth. That's something we obviously like to see. But here's where we start to get into what I think is a little bit more interesting, honestly. Over the course of the year, MPLX returned $4 billion of capital to unit holders while maintaining a strong distribution coverage ratio of 1.5x. So via dividends and buybacks, they paid out about $4 billion to investors, but they still had plenty of cash left over. How do we know this? Well, because coverage was 1.5 times, which basically means they earned 50% more cash than they actually paid out. So that's very safe, it's sustainable. It's a very healthy coverage payout ratio for MLPs. But not just that. In November of 2024, they increased their quarterly distribution by 12.5%, making the third consecutive year MPLX has increased its quarterly distribution by 10% or more. So what does this mean? It means despite that high dividend yield and the fact they have a very healthy coverage ratio, they're growing their dividend at a very fast rate, with the most recent hike being 12.5%. So there's plenty of great information here, but what we really want to pay close attention to is what they were saying about the distributable cash flows. That's the key metrics for these MLPs, and you can see in their Q2 earnings slides, that's what's highlighted right here, distributable cash flow. This is the lifeblood for MLPs. It's like earnings per share or free cash flow for a more typical stock. And from it, we can use it to look at things like valuation ratios, the dividend coverage ratios. And again, in 2024, we can see at the end of June, in 2024, distribution coverage was about 1.6x. Right now, at the end of 2025, 1.5x. Again, it's in a very healthy position. And if we simply scroll down to the next slide, they highlight that distributable cash flow is growing at a high rate. So in other words, I think intrinsic value is growing at a high rate. at least for MLP, 6.9% compounded annual growth rate. And because of that, like we've already pointed out, they're able to grow their quarterly distributions pretty fast. Look at this, a 10.7% compounded annual growth rate. So when you look at that starting dividend yield at 7.5% and combine it with the fact they're actually growing the dividend at a high rate, you're going to see the yield on cost grows really fast. If we bought this stock about 5 years ago, your yield on cost would already be almost 24%. Even 3 years ago, it's close to 12%. It's really powerful when you can find a stock with a high yield that's also growing those dividends at a high rate. Now we come to the asset class that you're perhaps most familiar with potentially, and that's going to be REITs, real estate investment trusts. And most people actually own REITs, at least if you're somewhat dividend focused. And for example, one of the REITs that I own in my portfolio that's done pretty well is going to be Vici Properties. Currently up about 12% year to date when you don't include the dividend, and of course the yield currently sitting at about 5.51%. And like I mentioned earlier, REITs do have some similarities to BDC. For example, they're both required to pay out 90% of their taxable income in the form of dividends to shareholders. Now for REITs, the key metric that we're typically going to look at is going to be adjusted funds from operations. But not just adjusted funds from operations, it has to be adjusted funds from operations on a per share basis. And this is a very important point to make. And let me show you why. If we jump over to the ticker data stock screener, let's look at a popular REIT, for example, like Realty Income, stock ticker O. Here's what we want to pay close attention to. Come down here and look at shares outstanding. Now, typically when we see a stock increasing their shares outstanding, it can be a major red flag. It means they're diluting shareholders, and basically each share that you have is going to be worth less. And on top of this, if they're issuing new shares, that means all the other per share metrics like earnings per share, revenue per share, and free cash flow per share are likely going to go lower if you're diluting them by quite a bit. So again, typically, we don't want to see this, but that's not always the case for REITs, and this is so important to understand. Because REITs are required by law to pay out 90% of their earnings in the form of a dividend, it means they essentially have two ways to raise capital to continue to grow. One, they can take on debt, or two, they can issue new shares, and this is the capital that they'll have in order to acquire new properties, or really just develop the business in general. And what we can see from 2014 to around 2020, they really weren't issuing a whole lot of shares, and we have to remember during this time, we were operating in a lower interest rate environment, so it was a little more advantageous to take on debt during this time versus issuing shares. But in 2022, 2023, 2024, as we were in a higher interest rate environment, we can see Realty Income elected to start issuing more shares. Now, whether or not this is actually a good thing depends on one thing. Were they able to grow adjusted funds from operations on a per share basis? And if we look at Seeking Alpha, let's just go ahead and take a look at Realty Income. If we come over to the financial statements, we should be able to find adjusted funds from operations on a per share basis. Now to start, we can see adjusted funds from operations here, and we can see it was growing, but again, we have to find it on a per share basis. Now, one of my complaints with a lot of softwares is they don't do a good job of tracking these types of metrics, and a lot of the times they're missing data. So even Seeking Alpha, for example, is missing AFFO per share data for Realty Income. And keep in mind, this is the most popular REIT out there, so not a good sign for the smaller REITs if we're missing data on the most popular one. But again, this is something I've been building out in the Dividendology database at dividendology.com. So let's just take a look. So here's our REIT database. There's plenty of data that we have here. We have charts, historical AFFO data, payout ratio projections, historical and projected dividend projections. But again, we want to look at the AFFO per share data historical. So we can see right here, we have Realty Income, and we can see on a per share basis, adjusted funds from operations has essentially been growing every single year. Now, this is important because it essentially means that Realty Income is growing their intrinsic value, and that's projected to continue to be the case according to average analyst estimates. That's the key metric we want to be looking for when it comes to REITs. Now, on top of this, if they're growing adjusted funds from operations on a per share basis, it means they're going to be able to grow that dividend. Now, this is where you have to be really careful because not all historical dividend growth is what I would call sustainable dividend growth. If we jump over to our dividend breakdown sheet, let's look at an example. And for this example, let's just look at Pepsi. I know it's not a REIT, but it's a good example. Again, thanks to ticker data, the data will load in, and we can see the starting dividend yield of Pepsi currently sitting close to 4%. And if you know anything about this stock, you know it's a dividend king with over 50 consecutive years of dividend increases, and we can see the past decade what that dividend growth actually looks like. The 10-year dividend CAGR is about 7.24%, so a pretty decent combination of dividend growth combined with its starting dividend yield. But here's what a lot of softwares miss, and thankfully we're able to build this out with ticker data. But look at this free cash flow payout ratio over time. In 2014, the free cash flow payout ratio for Pepsi was actually under 50%. So they're not using the majority of their free cash flow to pay out dividends, which means they're able to reinvest back into the business. They can do mergers and acquisitions, buy back shares. They have a lot more options. But we can see they continue to grow that dividend. But because free cash flow wasn't growing at the same time, the free cash flow payout ratio actually continued to climb higher and higher. And in fact, in 2024, it was above 100%, which is undoubtedly a red flag. So what am I trying to say here? We don't just want to look for dividend growth, we want to look for sustainable dividend growth, because if a stock is growing its dividend, but at the same time, the payout ratio, the free cash flow payout ratio, or in the case of REITs, the AFFO payout ratio is growing, that's not a good sign. That would mean it's not sustainable dividend growth. So what does this mean particularly for REITs? Well, again, some softwares, and thankfully Seeking Alpha, does show metrics like AFFO payout ratio. For example, we can see for Realty Income, it's sitting at about 75% whether you look at it on a forward or trailing 12 months basis. But honestly, for me, that's not enough. This is an important metric, but I want to know what that trend actually looks like over time. So again, this is something I've been tracking in the Dividendology database. We can see Realty Income's payout ratio, their AFFO payout ratio over time. And what you'll actually notice is it's decreasing. This is a really good sign because even though they've been growing their dividend over the past decade, they actually increase it on a quarterly basis, the payout ratio has been decreasing. So not only has their dividend growth been sustainable, they can actually grow their dividend at a faster rate and still be sustainable. These are the exact type of trends that we want to be looking for. Now, on top of this, let's take just a minute to actually talk about REITs and valuation. And as I pointed out before, REITs are actually trading at one of their most compelling valuations in really over 20 years, with the exception of for a brief moment in 2020. How do we know this? Well, we can look at the equity earnings multiple spreads of US stocks versus US REITs. So historically speaking, what are we looking at here? This purple line is the median multiple spread, and it's telling us that historically speaking, REITs trade at a slight discount from a valuation perspective compared to other US equities. Typically, it's about negative 0.6, but right now it's sitting closer to negative 6.5. That is just a mind-blowing difference compared to the historical valuation. And for reference, look at how historically REITs have traded when that discount is negative 2 times or greater to US equities. 1 year later, REITs outperform 25.6%. 2 years later, REITs outperform, growing 18.7%. And 3 years later, REITs have outperformed with a total return of 13.9%. And while REITs are a somewhat out of favor asset class in today's time just because of poor performance recently, it's somewhat recency bias, REITs historically speaking have actually been outperforming the market. From 2002 to 2021, REITs returned about 11.2% annually. Meanwhile, the S&P 500 was about 9.5%. Both of them are very good, obviously, and the S&P 500 has done great over the last few years due to the tech bull run from the Mag 7 stocks. But REITs are out of favor, and it can't stay that way forever, especially with valuations being the way they are right now, and especially when you combine the fact that we're in a dropping interest rate environment, and interest rates are expected to continue to go lower in the coming months. At least that's what Jerome Powell has told us. So I'll definitely be using the Dividendology REIT database to continue to point out the best opportunities in the REIT market. Now, lastly, we have preferred shares, and I'm actually willing to bet even if you don't own any preferred shares, and if you haven't researched them, you probably understand them quite a bit better than these other asset classes. The reason is they're not too much different from typical stocks, at least when it comes to assessing things like the actual sustainability of those dividend payouts. So let's look at an example. We have some preferred shares from the company Public Storage. Now, the reason preferred shares are literally called preferred shares is they have priority over common stock when it comes to things like dividends and liquidation. So what does that mean? Well, to start, the dividends from preferred shares are typically going to be a little bit higher. They're going to have a higher yield than whatever the underlying equity is. But on top of that, preferred shares are also higher in the capital stack. Now, if you haven't heard the term capital stack before, it's actually pretty simple. It basically tells us who gets paid first in a liquidation event. So basically, if the business goes bankrupt, what's the order of people getting paid? And it's pretty simple. To start, we're going to see people with debt. So like loans, bonds that are backed by collateral, those are going to be the first people to get paid back if the company goes bankrupt, essentially. But after that, it's going to be preferred equity before common equity. So you're higher in the capital stack, so in a liquidation event, preferred shareholders are going to get paid before common shareholders. On top of this, preferred shareholders get paid their dividends before common shareholders would get paid their dividends. Now, let's go back and look at our example for just a moment. What we can see right here, what this 5.15% is telling us is what the coupon rate is. So what that means is they pay $1.29 per share, and based off that information, we know the par value is $25. Now, this preferred share is currently trading at $22.40. So this preferred share is currently trading below par value. Why could this be the case? Well, it could typically be to a few different reasons. Like always, to start, it could be interest rate sensitivity. As rates rise, there will be new preferreds getting issued at higher coupons, which will make the old 5.15% coupon rate a little bit less attractive. So because of that, there's less interest, which will push the share price down, but that all of a sudden creates a higher starting dividend yield, which you can see is the case for public storage preferred shares here, with yielding 5.78%. Now, the other thing we have to make note of when it comes to preferred shares is a lot of them are callable after a set date. Now, what does that mean? Callable means that the issuing company, like Public Storage in this case, has the right but not the obligation to redeem shares from investors at par value, which again is typically going to be $25 per share, and that's the case for PSA.PR.F. So if you bought today below par value at $22.40, you'd make a profit because if they called it back, you'd be getting $25 back. And on top of that, you'd be getting any of the dividends that you collected during the time that you actually held the preferred shares. On the flip side of this, if you bought above $25 per share and they called, you'd be having a capital loss, but that could potentially be offset by the amount you made in dividends. When it comes to dividend sustainability for preferred shares, just think about what you would look at for your more typical stock. What does the underlying holding look like? Is it growing earnings and free cash flow, or adjusted funds from operations if it's a REIT? What's the credit quality look like of the underlying stock? What does the balance sheet look like? Again, in reality, analyzing preferred shares, at least when it comes to dividend sustainability, is not radically different from the actual underlying holding. So what you can see from these 5 asset classes is there is absolutely opportunities in the high yield space to build a high yielding portfolio. A high yield portfolio that could yield 7, 8, 9%, and in some instances even a little bit more, and for those dividends to actually be sustainable. But again, this can be a dangerous game to play if you don't know what to look for. High yield investing undoubtedly has risks, but just like the old Warren Buffett quote goes, risk actually comes from not knowing what you're doing. And when you do successfully build a high yield portfolio, you get the dividend avalanche effect that can quite literally cut in half the amount of capital you would actually need to retire. This is why over on dividendology.com, I'm building a real money high yield portfolio from scratch and continuing to build out the database, continuing to put out research and interviewing fund managers. And along with this, I'm building out the dividend growth portfolio. Again, there's a link to dividendology.com at the link in the description, or alternatively, you can just scan the QR code that I'm actually putting up on the screen right this very moment. Along with this, be sure to check out tickerdata.com, which allows you to automatically import stock financials directly into your spreadsheet. So go ahead and let me know what you think of the dividend avalanche approach in the comments down below, and like always, please don't forget to like and subscribe to the channel.